after this, we'll get into more current time, April the 4th. Again, what I want you to understand is the importance of what is being viewed by these institutions and by the institutional traders, okay? So, as it relates to the basic economics 101 that we covered earlier, and some of the verbiage and some of the economic data releases from a micro level and macro level that we discussed, as it pertains to economic growth and interest rate changes, I want you to understand the relationship between what is being said on a day-to-day basis as it relates to price moves. And we are going to bring in more and more the relationships between price moves and what is being said here from the analysts. Okay? Hopefully we're making sense so far. And the question is how does this relate to COT data? And the COT data is, of course, the futures markets. And the futures markets will also price in advance what they anticipate, because the futures markets is the smart money, and they will price in advance what they anticipate the central banks to do as it relates to rates, economic growth, and capital flows. Okay? So let's look at this report. No dollar bottom yet. Euro wins the ugly contest easily. Okay. Euro US dollar peaks after, not before. Fed funds target rate has bottomed, so not yet. Okay? What they're saying here is this, is that the euro dollar is going to peak after, but not before, the Fed funds target rate has bottomed. So they're saying the euro is not done yet. Euro is going to continue to rally. This is April 4th. Euro is going to continue to rally when the Fed funds target rate has bottomed. Look at the relationship of what they're calling between the currency pair cross, when the reversal is going to take place, as it relates to the interest rate reports. Okay. So a cue is that a breakthrough 160 as Fed cuts to 1.5 or less. Okay. So what they're saying, as of April 4th, they're saying that like this reversal that we saw today was, or on Thursday, Friday, was this is the view as of April 4th, not as of Friday. So the view can change. But this would suggest that we actually could even spike again through 160 because the Fed is not done cutting rates yet. Okay? We are much less sure that ECB cuts soon and a bit surer. So they're not too sure that the ECB is going to be cutting rates anytime soon. Okay? More later than sooner. So they're saying that the capital flows are going to continue moving into euro in the near term, but they are quite sure that the Bank of England will cut rates even more. So the euro pound is likely to continue to rally into the summer. As of April 4th, they're saying into the summer. Things may have changed now because when a view is expressed, it can always be changed. Okay? I can express a view to you or a trade call to you 1 minute, and then 1 hour later I can change my view. Let's say I'm suggesting an intraday trade to you. I can change my view at any time because as time and price changes, my view can change as well. On a macro level, I can express to you a view now, but that can change at a later date. 1 week from now, 2 weeks from now, a view can change because we're traders. I'm not expressing a view to you and then becoming fixed in that belief, and so fixed in that belief that I refuse to identify changes that exist in the marketplace and adjust with the changes that are taking place in the marketplace that nobody can foresee. Okay? That's a very important point, and you need to listen to that point over again when you review this video. So, we are much less sure that the ECB cuts soon and a bit sure that the Bank of England cuts more. So that means the euro pound is going to rally. and hold above 80 into the summer, much higher than previous forecast. The euro-US dollar rises hard. Okay, this was at April 4th, so it actually rose a fair bit since then. Cable is static if the dollar rallies. If the dollar rallies, pound is going to fall, and fall hard. Okay? Either way, the pound has peaked for this cycle for sure. On this note, let's look at the chart. Pound US dollar. Okay, right here, you see this point right here, this was April the 4th. Okay, right here is when they called this. When they said that because of rate differentials, the pound was likely to fall. And it fell 400 pips from that time. And then the fundamental scenario changed somewhat. We had some Fed injection and so forth. There were a number of short-term unpredictable economic factors that came into the marketplace, caused a bit of a rally to 2.0, then it has continued to fall. But this is where it came out. This is what happened with short-term flows, and you can see the short-term flows moving 400 pips. Okay? You see how that works? Those are the institutional flows impacting the FX market as it relates to what we've seen here. Here, in what has been said in this dialogue, you see the direct correlation between what the institutions are doing and what happens with price in the marketplace. So therefore, if we understand what's happening here, I'm looking to sell short. So then I go down into my technicals and I sell short technically. Okay? Markets have given up pricing in more Australian interest rate rises and are instead suddenly pricing in cuts in the second half. That was on the 4th. That's changed now, but they're now pricing in cuts in the second half. Therefore, we saw Australian dollar pull back somewhat. These feel like dangerous, even watershed days for the Australian dollars in a higher volatility world. Sell it. Yen longs still appear on the other side. Okay, so which means sell the Aussie yen, sell the Aussie dollar. As of April 4th, that was the view. That was before Australia. Those of you coming into Pro Traders Club, you know that on Monday and Tuesday we had some very significant economic data that came out of Australia that was bullish Aussie dollar. Therefore, this view has changed since. So you see how the capital flows in relation to the current view. Okay? And if we understand this view, we move with the current flow. Here is, no, we don't want to pay attention to that one. Okay? Just a couple more bullet points in this. This is a quarterly review. Just a couple more bullet points that I want to cover here so that you can get a feel for what is being said versus and interpreting the sentiment into price. Risk reduction rules for the rest of the year as banks remain occupied with balance sheet rebuild. Okay? This is a little bit outside of our scope, but let me just explain what this means. Risk reduction. When the market means risk reduction, what they mean is this, is that okay, this is going to be long-winded. The market has borrowed yen to move into high-yielding to risky assets into higher-yielding currency called the carry trade. And they move into foreign currencies and then foreign equities, foreign fixed income by borrowing yen, leveraging money to borrow yen, and moving into Aussie dollars, pounds, euros, to some degree US dollars, New Zealand dollars, on borrowed yen. The market, so they're saying risk reduction. So we've seen a reduction in risk by the unwind in the carry trade, the rally in the yen, because the yen has rallied, because as fund managers' portfolios decline in value because of the credit crunch, because of a drop in the equities market, they need to run away from their risky assets, and they need to move back into the safety. So they need, if they're being squeezed in their margins, they need to get out of those positions and move the funds back in. They need to pay back those yen loans. So they go and they pay back the yen loans. So what does that do to yen? They need to buy the yen back that they borrowed, so it's going to cause the yen to rally. So the yen's going to rally against the pound, the euro, the Aussie dollar. That's why we saw the yen crosses unwind or fall. So they're saying that this is likely to continue throughout the year. Right now we are in yen is weakening, so we're in a bit of a rally stage. We're in a bullish or in a risk environment, in an overall risk averse down cycle is what they're saying here. So we're likely to see the yen continue to rally throughout the year. So that's what they're saying in a nutshell. For more details on all of this information, I cover this in a fair bit of detail in the Pro Traders Club. And now that you all have, with this webinar, you have access to Pro Traders Club, and there's an enormous amount of information in those videos that relate to this concept and this sentiment. But I want you to understand that this is how the banks are thinking. This is how the funds are thinking. And this is what's determining capital flow. And if you understand it, it gets you more acquainted with the marketplace. Okay? Let's move down. The aggressive view on lower pound yen was so well timed, while the lower euro yen view demand eternal patience. Stick with it. What they're saying is this, is that pound yen has fallen more aggressively because of the anticipation of further rate cuts in the UK, as well as a flee to repatriate yen loans. That's why the move on this has been bigger, because of the negative tone around the UK, negative reports in housing, real estate, economic growth, and so forth, retail sales. That's why this is more pertinent now. However, in the Eurozone, there's been indication of relatively stronger economic growth, rates remaining on hold. That's why it's going to take longer for this one to start to fall and collapse, is what they're saying. Okay, I'm not saying that at this particular point in time, as of today, April 26th, that I agree with this. I'm just telling you how the information flow is passed on through to those who are dropping $1 billion a trade in the marketplace, which affects price. Okay? As we move more into relevant times, we are going to, I'm going to talk a little bit more relevant times later on. What matters most for the dollar in the next 3 months, which is actually pretty much expired, where and when the Fed reaches its terminal rate for this cycle. So what they're saying is this, the Fed is lowering rates right now. And the market is pricing in a 1/4 to 1/2 point interest rate decline before taking another view. The market has pretty well priced in that 1/4 to 1/2 point rate decline right now. Therefore, there's a sense that the US dollar could be bottoming out. So, now what the market is waiting for, what tone is going to come out of the Fed and what is the terminal rate is going to be for this cycle. So that is what they're waiting on. That's what's going to matter most for the dollar. Excuse me. In the next few months, as of the time of this report. So, the Fed is en route to a funds target of 1.5% at the least as of the time of this report. It could cut to well below that, but let me say as a side note, the Fed's looking to cut rates to about 1.5 at the least. However, the problem with the credit crisis is the credit crisis has brought in an external factor that is not necessarily directly related to rate cuts. It's an aberration in the marketplace. It's abnormal to the marketplace because Fed rate cuts cannot necessarily manipulate the markets to the same degree that it normally could, because normally it is an absence of the credit crisis situation. Therefore, the rate cuts is going to have a bit of a different interpretation in the marketplace. I'm sorry if this is getting heavy for you, but we are going to bullet point this into the core facts that you need to leave here with, and that is rates and economic growth. I get into a lot of detail because it gives you something to think about. Okay? And once again, I want to give you the real core realities of what's going on in this marketplace. This is FX trading. This is what goes on, because these funds, not only do they trade spot, but they're also taking on a lot of different types of trades. Like in our trading, we trade in forwards and swaps. We trade in exotic options type strategies. So we're taking on a big range of different factors in our trading, and that is reflected in the flows in the marketplace. So one of the responsibilities that I have to you is to challenge you to understand what's going on. Because if you're just trading off of a trend line break and you have no idea what's going on in the marketplace, then yes, the technical factors override. Yes, I am a pattern trader. Yes, I trade based off of price. But I also understand what's going on in the marketplace, okay? And the fact that I understand what's going on in the marketplace is I know the direction and the flow, therefore I can position myself into longer-term positions as well as get a feel for what the short-term market is doing and be in the direction of the short-term flows and understand why. So when I'm saying sell rallies, there's a reason. Sure, the market's going to rally as the long-term flow and the long-term outlook is bearish. Sure, the market's going to rally for maybe 1 day, 2 days, 3 days. But if you sell into it, you know that there's weakness in that rally because of the underlying fundamental factors. Okay. Furthermore, let's go on to some more points here. ECB. Cuts probably come later than previously thought, and the question becomes, how far does the ECB cut into 09? It is probably easing next year well after the Fed has ceased. So what they're saying at this point in time is that at this point in time, they're saying that the ECB is probably going to cut in 2009. But now, after Thursday's events, the ECB, now the market's anticipating that the ECB is going to cut in the fourth quarter this year. Therefore, the market is selling euros now. Okay? That's why they're selling euros now. They're anticipating a cut in the fourth quarter instead of 09. So today, in April, and in May, they're selling euros for what they anticipate in the fourth quarter. Okay? And they're saying that the ECB is not going to cut until after the Fed rates stabilize. So after the market stops pricing in what it's going to do with rates, after they stop putting rates on hold, somewhere around the 1.5 point mark. Okay? It is probably easing next year while the Fed's cover that. Okay. The Aussie dollar looks likely to be the next FX carry shoe to drop. Okay. Most important in terms of potential tipping point, markets have given up pricing more RBA tightening and have started to price cuts for later in 08. Now, let's talk about this Aussie dollar, because that's not what we've seen recently, is it? let's talk about Aussie dollar. Let me try and recall the data that came out of Australia. Specifically, let me move away from this window. Moving away from the window now, so it's probably blank to you. This is an Australia dollar, US dollar chart. And the market was pricing in rate hikes, strong economic data. We saw a significant pullback here, as was referred to earlier, and we saw a couple of small pullbacks. And then we saw the market, what happened was what were the economic reports that came out on Monday and Tuesday, or Monday and Wednesday? One was CPI came out higher than expected, and I don't have my, PPI, thanks Ed, PPI 1.9% versus, I think it was 1.1% expected, and then they came out, what was it, Ed? What was the other report? It was 1.3, I think it was CPI, or GDP, came in at 1.3 versus 1.1 expected. So therefore, we saw price rally, we saw Aussie dollar rally aggressively, and then we saw, again, a general pullback in the tone, or rally in the US dollar tone here. Okay, and so that is why we've seen the capital flows increase in the Aussie dollar as of late. Thanks, Ed. CPI was 1.3% versus 1.1 expected. You see that, folks? Ed and Toby, thanks. Ed and Toby, both long-term members of the Pro Traders Club. And the reason why they know that is because, first of all, we've trained them to look for these things. Although they on their own are very smart guys, and they probably, know that on their own without my help. But they also are members of Pro Traders Club, and hopefully we can help you guys maintain an awareness of those facts. But that's why we saw the Aussie dollar rally, and then we've seen some risk aversion later on in the week. Okay, so let's move. So what I like to do is I like to relate the fundamental aspects as it relates to price on the longer term charts here, on the daily charts, because it's more pertinent. Let's move away from this window and back to our fundamental. Okay, so the market is now on hold. There was actually the sentiment after the CPI and the PPI. There was actually the suggestion that Aussie could even continue to hike rates, but at the least they're going to hold on rates. Therefore, that's strong U.S. dollar. Okay, folks. Fundamentally, the U.S. dollar is well supported because the market is moving into Australian dollars. But hey, who called it in November, December? Come on, folks. Just teasing you. I'm just going to tell you when I was right and not when I was wrong. That's how we work. No, come on, I'm just kidding you. This is okay based on this bank's perspective. Here's some forecasts, and these forecasts can totally change based on the ever-changing and unpredictable market environment. Okay, so these forecasts can definitely change, but they just give their clients a list of their forecasts over the long term. How they can determine into 2010 is beyond me, because I more like to look at the medium-term changes, but that's beyond me. But anyway, they just give a list of how rates can change. Let's look at some technical analysis, and we're going to cover this a little bit more later, but the reason why I'm showing you this now is because it's a part of this quarterly report put out by the Royal Bank of Scotland. All right. So we're deviating away a little bit away from the fundamentals, but these technicals are separate from the fundamentals. In some cases, they will be congruent with what is happening on a fundamental basis, but in some cases, it will also be contrary to what the fundamental view is, because it's what the market is actually doing, so, or maybe it's perceived as contrary. But we've seen what the market does in response to the fundamental outlook and what the funds are doing. So now, let me explain this. This is a bank, a dude who's paid, dude, female dude, just don't mean to be gender specific here, because there can certainly be women that are technical analysts in the bank environment, but I happen to know that this person is a male dude. So anyway, this person is a technical analyst that is paid by the bank. They're an internal analyst, and these reports will also go out to the fund managers, to the institutional private clients, to the corporations who they deal on behalf of. They will go to the proprietary traders and those whom are typically clients of the bank. And these may or may not be available to you. These particular reports are not available to you, but there are some that are available to you that I can show you later. So, but there are some central themes that I want you to pick out. And you know what? To be honest with you, I can look at this report, but it doesn't necessarily mean I'm not gonna look for trades that they're looking for, because from the time that this report is released to the time that price begins to take action, it can be two totally different things. So, and also, this is a monthly chart here, a monthly candlestick chart. So it's a really, really longer term view, because the report that we're looking at right now is a quarterly review. Okay, so Euro US dollar price is currently locked within a relatively broad, choppy 153.50 to 159.00 range. And this is at the time of this report, okay? So it's moved since then, obviously. We're still looking at an older report. Interweek trading range. Okay, first of all, let me say this. Okay? Does this technical report look like rocket science to you? Does this analyst have indicators splashed all over their chart? Does it look like something that is highly proprietary and highly secretive that we cannot relate to? Is there anything in there that we have not already learned or already understand about our trading protocol? This is an RSI 9 that is smoothed, okay? But don't tell anyone, okay? Shh, very highly secretive. Candlestick chart, trading range, trading channel, increasing trading channel, parabolic trading channel. Longer term, okay, interweek trading range. We all know what a range is, don't we? We can identify a range, can't we? Well, if the banks are looking at ranges, why don't we look at ranges? If you're looking for a magic formula, a holy grail, the majority of my trades are based on ranges. Okay, it's obviously there's a lot more detail to it that I train people on. That if those of you who take my courses train you on, but I trade effectively based on ranges and patterns and parameters within the larger ranges. That's how I trade. Okay, I'm a discretionary and pattern trader. So longer-term direction will be dictated by the correct interpretation of current price action. This favored interpretation is, okay, price action, price action, price action, price. Did any of you hear my interview with Greg Crisp, an individual who I trained to trade and has become so tremendously successful. I can't even tell you what his account has grown to, but he is now going to be managing some funds, and he is just developed as a tremendous trader based on these things that I teach, and he really listens closely to what I have to say. So let me just talk. What I want to do is I want to talk to you in concept here. Fibonacci projection of the December 2007 reaction low, projected multi-year channel top. Okay, we're talking about Fibonacci levels and channel tops. Is that rocket science? Okay, is it rocket science to you guys? Is it a magic formula? Okay, next question. Does it require discretion? Okay, and when anything requires discretion, there needs to be an allowance for margin for error, for margin for you're not going to get the exact 100% of the time the exact move. Okay. The alternative read, so they're saying, look, there are other alternatives here, and the alternative read on this is 5350 to 5900 consolidation range continuation pattern prior to the resumption of a primary uptrend, which is consistent with the fundamentals. Okay. Oh, we lost the picture. We lost the picture. Okay, there we are. We're back. Sorry. I played with something technically that I don't know anything about, and it backfired. Okay. The alternative read, the heavily overbought readings apparent on the monthly momentum indicators, RSI 9 smooth, rocket science, plus the close proximity of significant support target on the US dollar index support the topping scenario with a downside resolution of 5350 to 5900 range expected to trigger in the second quarter, which is what we're in now, second quarter to third quarter 08, and a decline towards 49.05. Okay, look at this. 49.05 key support. I have a question for you. Can you see key support on your chart? You can see key support on your chart. The same key support that the banks see on their chart. So, what difference is there between you and the bank? They're looking at the same support that you are. Clara, thanks for the note, but I think that was sent before. We have a picture now. Good stuff. We do have a picture. Okay. So we're just talking about support and resistance levels. Okay. Again, they're using retracement levels here. Retracement of the 50 and 62% retracement levels on the larger time frame. Look at this picture here of the pound dollar chart. 50% retracement, 62% retracement levels, trend lines, trend channels. Okay. Euro pound bearish divergence. Okay, they're seeing a bearish divergence on the daily and weekly charts against the RSI smooth 9. Okay. Don't tell anyone about this RSI smooth 9. Okay. They use a 23.6 Fibonacci retracement level. Again, we're seeing more technicals, just a pennant, a downward channel on this chart. US dollar. Let's look at some of the verbiage coming out of this US dollar scenario. Okay, moving back to verbiage outlook on the US dollar. Some of you may be getting tired of listening to me, but you're going to have to go through this 3 or 4 times. I'm doing this because I love you. Okay? After the 75% basis point March rate cut to 2.25%. Expect another 50 basis point cut on April the 30th. Okay? This is the view. This is the view much earlier. Now the April 30th rate cut is looking like it could be a 1/4 point, or it could be a 1/2 point. It's probably going to be more like a 1/4 point. Okay. Now, because the markets now, you see how the U.S. dollar has rallied a little bit against the euro, and some fundamentals have changed. It could be a 1/4 point, because the Fed wants to allow themselves some flexibility to cut rates even more if they need to later. So therefore, if they only cut a 1/4 point on the April 30th, then it gives them more room to breathe, and therefore we could see a bit of a support for the U.S. dollar. Okay, and a further reduction by 25 basis points in June 25th. I want you to understand this. They are pricing in now, or at the time of this report, which was April the 4th, they are pricing in now what they anticipate for June 25th, okay, and later. Bringing the funds rate to its terminal level of 1.5%. Risks to that, there's always a risk side. There's no 100%. There's not 100% that this is going to happen. There's always a risk. And risk to that forecast are on the side of lower rates. Okay, so they're saying that right now we're calling for 1.5%, but it could even be lower than 1.5%, which would make the U.S. dollar a carry trade and sell off even more into oblivion, but less likely. The Fed's already shown itself willing to consider remedies beyond orthodox monetary easing. In other words, financial manipulation. And don't even get me started on the fact that the financial institution is basically legalize crooks, and what the consumer and the taxpayer suffer based on the monetary easing and the injections of liquidity that they place in the market. You know who pays for that? You. You pay for it. And you know who makes the money? The fund managers who have lost all the people money are still making their money. And okay, that's just a side opinion. And opinions expressed here are not necessarily the opinions of the larger coordinate groups. All right, I know I'm going to get some emails on that one. Okay, look, folks, I just want to, challenge you a little bit, just stir you up a little. I'm not trying to be like Kramer or anything like that. I'm just having some fun. Big turns in euro-US dollar normally lag rather than lead through trough in policy rates, and also typically come after the U.S. curve reaches its steepest point. So what they're saying here is that actually the euro-US dollar could continue to see 160 again, or even higher, because once the U.S. dollar flattens out is normally when the euro-US dollar curve really starts to move. So they're saying the euro is not going to really drop and really trend in favor of the U.S. dollar until U.S. rates flatten out. You see the relationship, folks? Because you're going to make most of your money in the long-term trends. That's where the most of your money is going to make if you really understand, if you really get into this FX business, not just pressing buttons on a highly leveraged account on an intraday basis. Okay? Yes, you make money that way, but you'll make even more doing this. And this is also going to help your intraday FX moves. Okay? As the Fed continues to cut, we are not there yet on either criterion. Cue a move yet higher euro-US dollar into the 160, 165 range. Okay? This was obviously written earlier before 160, but they called for the 160 move. U.S. dollar recovery will not last if it is not supported by relative spreads. Okay? Everything that we've learned today so far, we are talking about rate spreads and relative spreads, rate spreads, economic growth. Here they're saying, like, look, pretty much all the marbles on U.S. dollar recovery is pretty much going to be supported on relative spreads. So if you're trading U.S. dollar, which is 89% of the currency volume, you need to be aware of rate spreads, and that's my job. ECB rate cuts would do most to undermine the higher Euro-US dollar view, but are probably delayed. Okay? In 2009, which is a bit too far out for me, the rate spread argument will turn as the ECB starts to cut interest rates at a time when the Fed is done. Well, that has actually moved after recent data or recent sentiment. This 2009 has now moved to Q4 2008. You see how that changes? How the sentiment on this tone generally tends to change. Okay? Euro. Okay? The ECB is maintaining its traditional hawkish stance, and this is as of April 4th, and that's why we saw a reasonable jump or continued flows moving into euro, because of the hawkish stance, meaning that they are likely to hold rates and potentially increase, and cannot be expected to ease while inflation remains high. Wage upwards appear to be delivering some sort of second round effects from the rise in food and energy prices, and while growth is not slowing modestly. So saying economic growth is not slowing modestly, there is an increase in inflation because of the cost of gas and the cost of food, but of course in the US they don't use food and gas, so it's not included in the CPI, except core CPI. So, but you know, so let's just fudge the numbers to make us think that we're not inflating when in fact we are tremendously. So, I'm sorry, was that a personal view? But in Eurozone, they're acknowledging the fact that there's a rise in food and energy prices, and then general economic growth is not slowing, so therefore they will maintain a hawkish stance as of April 4th. Okay? Don't expect any general weakness in the euro until well into the second half of these analysts' expectations. That could change now. We see some weakness, some signs of weakness in Germany based on the IFO as of last week, but we need further support of that. Rate cuts are likely to be slow but extended, okay, which means that, we see a long curve between US dollar support and euro decline. Okay? There's still more. Okay, we're going to take a break soon. Okay? I'm going to quickly go over this. There's a comment on this. Okay. Okay. Japanese retail investors have been raising foreign currency assets mainly through investment bank trusts and FX margin accounts. Okay. Let me explain this. The yen has been rallying because investment trusts and FX margin accounts, a lot of these accounts margined money to borrow yen to move into carry trade. So they all had to repatriate their funds so that they weren't hitting margin calls when the yen was rallying like crazy and when their equities dropped in the credit crunch. So therefore, it's caused the yen to rally. I mentioned that earlier, and that's what they're saying right here, okay? That the yen has had significant capital flows because, and it's been supported because the market has had to, all the yen that was borrowed all over the world by all the funds in the banks and the Japanese housewives managing funds had to move money back into yen. So their typical trading pattern has been contrarian. Even though the yen interest rates are low, the yen has had to rally because of other factors, external factors. They buy foreign currencies when the yen appreciates. So when the yen gets stronger, it gives them an opportunity to move into Australian dollars, New Zealand dollars associated, and they sell them when the yen appreciates, but over time they have accumulated a stock of foreign currency assets, which is what we do with the carry trade. We borrow yen and we buy foreign currency assets. Long-term yen domestic carry traders are still broadly unhedged, which means there's more risk for the yen to rally. If dollar yen and other yen crosses keep falling, they may begin to hedge long-term positions. Okay, I realize that this is really deep, and I'm just going to broad brush it because it's a little bit too deep. This kind of stuff we'll cover in Pro Traders Club when you come and visit me there. Margin trading companies usually request clients to use stop-loss orders so as to keep the initial margin value at a certain level. Okay, so these stop losses get hit and they move money back into yen. That's why we saw significant yen in futures. We've seen yen rally considerably. We've seen the yen crosses fall considerably late last year and early this year as the carry trade is unwound. This is too much detail for you. I'm not going to go into it because we have a ton to still cover in this session. Once Fed cuts are finished, look for the pound dollar to fall more sharply into the mid 180s. It is now a mini dollar with falling house prices, exposure to financial services, and a wider current account deficit. Never mind that. Okay, let's take a break. I know one more thing before we take a break. This is Norwegian kroner, where they are raising rates right now, and rates are already higher than the U.S. and Euroland, and Norway is closing in on high yielders. Therefore, we are seeing the Norwegian kroner increase in value. Norwegian kroner is rallying because rates are increasing there and capital flows are moving into the higher yielding currency in fixed income. With the UK having cut in February and probably to cut again, Norwegian rates will shortly rise above UK rates for the first time since August 2003. Globally, demand for yield is a function of expected volatility and general risk appetite. Both are likely to play negatively for yield attraction. The idea is this. Norwegian kroner is a high yielder. Money is moving into it. Its value is increasing. It is rallying. Money is flowing into Norwegian kroner. Let's take a break and see you in 5 minutes.